Okay, let's take a look at some transactions here and get a little practice with the debits and credits activities. One of the reasons I put this worksheet together is to hopefully work with you through some of these transactions and get the whole process of recording debits and credits, cost of goods sold, the trial balance in a worksheet, and tying all of that into the financial statements. But I'm going to break up these sessions here into the different worksheets that we have until you get to the section in the course that's appropriate, and you can look at the other videos. And then in the end, I'm going to tie them all together so that you can get the final uh, general review of all the different areas, and hopefully that'll help some of that to sink in. Okay, we have a company here, XYZ Company, and we have, by now you should be familiar with the accounting equation, assets equals liabilities plus owner's equity. And also I have here um, two columns for the assets, two columns for liabilities, and two columns for owner's equity. And then I've also indicated that the plus sign is showing an increase and the minus sign is showing a decrease. Okay, so on this side here you have debit increase, credit decrease, and on the other side of the equation, okay, you have the opposite. Okay, so let's start with some of these transactions. You are the owner of this company, and you are going to invest $10,000 to begin. We're going to assume that this is January 1st, and you're starting your own business. It's not really important what type of business it is right now, but you have $10,000 in your pocket. Let's go down here to the transactions, and you can see the first transaction says that the owner invests $10,000 into the business. That's $10,000 is cash that's coming out of your pocket. Okay, so obviously what we're going to do is we're going to come here into the cash account. That cash is an asset, and we are going to debit this account for $10,000. And I've also included a column here that is going to add up these figures just to make sure that we stay in balance as we post these entries. Okay, now we're off by 10,000. That means that on this side of the equation, okay, we have to um, put an entry in so we can balance the equation. And what we do is we look at these accounts here. We say, well, what is it that increases our cash, but what does that do to the other side of the equation? And over here we have the account called owner's equity. The owner's equity is the capital that you as the owner you have in the business. And what you're going to do is you're going to come down to this account and you're going to come not to the liability side because this is not money owed, but to the owner's equity side, and you are going to put a credit, that is, that side is being increased also by $10,000. Okay, so now our proof here is 0, so we're good. Now, the next transaction, let's go down a little bit. I'm going to come up here and I'm going to freeze this panel here so this way we can see the headings at all time. So we come down to the next equation and we see, the next transaction says that $8,000 of the investment is put into the bank. Okay, so obviously what you want to do is you open up a bank account. Now you don't want to leave $10,000 lying around in your business, so you're going to put it in the bank. But you're going to keep 2,000 on hand just in case something comes up, you got to pay cash. So what's going to happen here? Well, you're putting $8,000 into the bank, and where is that money going to come from? Okay, it's going to come from the cash account, right? So this way we're going to take out $8,000 from the cash, and as you can see, the balance in the cash now is 2,000 and the balance in the bank is 8,000. Okay, does that make any sense? So basically what we did here, we debited bank for 8,000 and we credited the cash for 8,000. Okay, so we're still in balance. A debit and a credit on the same side is not going to change the balance of the equation. Okay, next transaction. Let's go down to line 24. The company buys inventory for $1,000 on account. Now, on account is just an accounting term that means on credit. So we use up $1,000 to buy inventory. Inventory is the merchandise what we're gonna buy so that we can turn around and sell, hopefully for a profit. So now, ordinarily, some companies would put that in the inventory account, but I've mentioned in the lessons that there are two ways to account for this. One is the perpetual, which means that we're constantly keeping track of the inventory account and the cost of goods sold. And the other way is simply to put everything into the purchases account and then calculate the cost of goods sold later on before we do the financial statements. And most companies, that's the way they do it. They put it in the purchases and they calculate the cost of goods sold. That's what we're going to do for this exercise here. We are buying $1,000. Okay, I'm sorry, that's not going to go here. Okay, because we're under the asset account. We have to come into the equity account. Now, basically, what happens is that your revenue account, which is the income, and the expense accounts, purchases, interest, rent expense. Eventually, what's going to happen is when you calculate the difference to see whether or not the company had a profit or a loss, eventually these are going to come back into the owner's equity account. So rather than having a separate income column and a separate expense column, we're going to put everything into this account here, and you're going to see when we look at the other worksheets how they all come together. Okay, so we are buying $1,000. Okay, that's our debit. Okay, so the we're putting $1,000 into the purchases account. And where is that money going to come from? Well, let's read carefully. It says company buys inventory for $1,000 on account. So that means that we are buying on credit. If we're buying on credit, that means we owe somebody money. And this is the account right here, accounts payable. We're going to come here and we are going to um, increase the liability account for $1,000. Okay, so just to make sure that we have this correctly, we are debiting the purchases account. Now, even though it says there's a negative here, but remember this is the expense account. So basically what we're doing is we're debiting the expense account, and temporarily now we're putting it into the equity account. And then we owe the $1,000 to the vendors where we bought the merchandise. And so now our entry is in balance. Okay, we have a debit to purchases and a credit to accounts payable. We owe $1,000. Okay, let's go down to the next transaction. Over here it says the company pays half of the bill, $500 with a check. This is the purchases we just made. Okay, now the next day or a couple of days later, you, as the owner of the company, you decide you're going to pay $500 with a check. So basically what's going to happen is the you're not going to owe $1,000 anymore. You are going to debit the liability for 500, okay? And if you're paying with a check, where's that money coming from? It's going to come from the bank account, okay? Because when they cash a check, that money is going to come out of the bank account. And so we are going to credit this account for $500, okay? And we're still in balance. Next, it says here that the company buys office supplies for $150 cash. Office supplies. Office supplies are things like paper, pens, uh, notepads, and things that we need to for the day-to-day operational activities in the office. And so the office supplies here, we are going to pay. Let's see. Company buys office supplies for $150 cash. So this means again, and I've mentioned this before in the lesson. There are two ways to account for office supplies. Either we put the whole purchase into an expense account, and then at the end we find out the ending balance, and then we adjust so that we know what the asset is. Okay, these are your assets: cash, bank, accounts receivable, office supplies, inventory, fixed assets. Okay, that's your asset category. liabilities, accounts payable, long-term notes payable, equity account, and then your revenue account and your expense accounts down here. Now, the most popular way most companies do this is simply to put the purchase into the suppliers account right away, and that's $150. And how did we pay for this? Let's go back and double check that. Company buys office supplies for $150 cash. So this means that the money has come out of the cash account. Okay? Here's the cash and here's the credit. That means that we are going to decrease this account. And I'm going to do an F2 here and put a formula so that I can include plus 150. Okay? So that we're back in balance here. All right, what's the next transaction? Company buys equipment for $1,200 on a long-term loan. Now, equipment, whatever machinery that we need to operate the business, that's the fixed assets. Okay, they are long-term because their life span is usually longer than 12 months, and so that's the fixed asset. So we buy fixed assets for $1,200. Is that what we said? Company buys equipment for $1,200, but we didn't pay cash for it, and we didn't write a check. We simply took out a loan for that $1,200. And so the next account, the liability account that we're looking at, is long-term notes payable. We're going to come here on the credit side and record that we owe the bank $1,200. Okay, and we're back in business. We're zero balance here. Okay, now the company, now this is you again. A couple of days or a month later, the bank sends us a statement, and then they say that our first payment is due on this $1,200 note, and we're going to pay $200. And out of that $200, $150, which is the majority portion, the largest portion, is going to be interest, and $50 is going towards the principal. Okay, so the first thing we're going to do, we know we're going to pay with a check. Okay, so we're going to take out that $200 from the bank. Okay, let me put another formula here again. And we are going to add $200 here to show that we're paying with a check. Now we have to balance the equation. We're off by 200, and out of this note, $50 of this is principal. Okay, so this reduces, if you look over here, this reduces the note, the $1,200 that we owe, only by $50. Now, where's the other $150 is going to go? Well, it says here that $150 is interest. Now, interest is an expense, okay? And so we're going to come down here to the, we're coming here to the expense account, interest expense, and we are going to put that in the owner's equity area for $150. Okay, so we're back in business. We're at zero. Now, the next transaction, the company sells merchandise totaling $2,000. So finally, we're starting to bring some money into the business. Okay, we turn around and we get an order, and somebody wants to buy $2,000 worth of the merchandise that we do sell. And so what that is that it's income. Okay, so we have sales, income, and we are going to credit that in the owner's equity section because that's where it's going to end up anyway. We are going to credit that for $2,000. Okay, and you see the credit here is a plus, and we're going to credit that $2,000. Where is the other $2,000 is going to go? It says that we sold merchandise, $2,000 cash. That means that we had cash coming in, so we have to come to the cash account, and we have to, let me put a formula here again. We have to add $2,000 to this account, and giving us a total now in the cash account $3,850. Okay, and we're in balance. Now, the company sells merchandise again, but this time not cash, but we're going to sell on credit. Somebody wants to buy $800 worth of our merchandise, but we're going to sell to them on credit. And what does that mean? That means that we are creating a receivable. Somebody owes us money, not a payable. A payable is when we owe somebody money, and the receivable is when someone owes us, and then we're waiting for the payment. Okay, so that's $800 that's going to increase, and again, because we're selling merchandise, we are going to increase this account. Let me put a formula here. We're going to increase this account by $800. Okay, so you see, so altogether now we've sold for $2,800 worth of merchandise, and these are the balances in the individual accounts. Now let's move down to the next transaction. Customer sends a check. This is the customer that just bought from us on credit. They sent us a check for $500. So this means that they don't owe us $800 anymore. And how are we going to account for that? Well, we know that this account has to come down, okay, by 500 because they paid, and they paid with a check. Now, even though they paid with a check, we're going to consider the check a liquid asset and consider it cash for now until we actually deposit it in the bank. And so here we are going to put another $500. Okay, so our cash is increasing and the asset accounts receivable has decreased, and it went from 800 to $300. Okay, so not bad. We're doing good so far. Now the company, you as the owner, you take a look at your balances, and then you realize that, oh whoa, we have too much cash on hand. We don't want people to be tempted to turn around and try to steal the money. So we're going to put $4,000 of this excess cash. We're going to deposit that in the bank. Okay, and that should be relatively easy. What we're going to do is we are going to increase the bank account, okay, because that's where the money is going. We're putting $4,000 into the bank account, and we are taking that out of the cash account, okay? There you go. Now in the bank, we have where we have most of the money. We have 11,300, and then we have cash or petty cash, whatever you want to call it, sitting around is $350. Okay, and finally, it says here that the company pays rent, um, $300 cash. Your landlord comes and tells you that the rent is due. Now we have to pay rent for $300. So we are going to come, first of all, we find the rent expense. It's an expense. We put $300 in the expense, okay, under the equity section. And then how do we pay for it? We paid cash. Okay, that means that that money is coming out of the cash account. So we have to add $300 here as money that's coming out of the cash account, so that we end up with $50 here in the cash account. Okay, now, um, physical inventory shows a balance of $250. So we've had a pretty good period. Okay, let's assume that this whole scenario here, all these transactions took place over a 12-month period. And that's not too bad, okay? This is a brand new business, and now you're going to sit back and we're going to try to organize all these transactions and put them together into something that makes sense. All right, but I'm going to stop there because this physical inventory, we can't post it here as a debit and credit. We have to actually calculate the cost of goods sold before we can go ahead and put an entry and and get that as part of the our activities, our transactions here. Okay, but as you can see, we started off with 10,000, and then we had all these different transactions, and then you see how the debits and the credits, how they have to balance out. We have to have what we do to one side, we have to do to the other side. Okay, and because we're keeping track here via these formulas, and we can see that we have a zero balance here, so therefore our debits and credits um, are correct. Okay, we're in balance. All right, that's it for this session. And the next time we come together, I'm going to show you how to do the cost of goods sold, how to calculate that, and we'll move from there. All right? Okay, that's it for this session.